Welcome to my educational channel on finance, banking, risk management, international trade, and other important domains. I am Sudham Ghosh, a global instructor and a premium instructor on Udemy and Allison platforms. I have 10 courses on Udemy, which are very popular with students across 96 countries. In this series, let me take you through my course on Mastering International Trade and Trade Finance for bankers, students of finance, exporters and importers, and trade professionals. One can deep dive into the complex world of international trade and find financing solutions for both importers and the exporters. You can find the complete course link in the description of the video. Please watch the video till the end to fully comprehend the subject. If you find this video useful, please consider to subscribe to my channel, like my video, share it among your community, and also provide valuable comments. So are you ready? Let's start.
Welcome to this class. Let's understand what is trade finance. What is trade finance? Trade finance is the financing of goods or services in a trade transaction at any point from a supplier all the way through to the end buyer, or rather financing the whole supply chain from procuring of raw material to manufacturing to export of finished goods or semi-finished goods to the importer and also to the ultimate end user. Well, supply chain is a large network of producers, vendors, warehouses, transportation companies, distribution centers, and the retailers. Trade finance typically involves at least three parties: an importer or a buyer, an exporter or a seller, and a financier or a bank. In any business, managing cash and working capital are the two components that are critical to the success of any business. The financial institutions typically finance both the exporters and the importers by reducing payment gaps in a business operating cycle. The operating cycle involves two major components: the cash cycle and the working capital cycle. The financial institutions or the banks provide finance to help both the exporters and the importers to buy goods and stock, which is often necessary when they don't know or trust each other parties in the supply chain. Well, that allows businesses to request higher volumes of stock or place larger orders with suppliers, leading to economies of scale and bulk discounts. Therefore, we can say that the trade finance is a tool that can be used to unlock capital from a company's existing stock, receivables, or the purchase orders. Let's understand it better. For any business, the operating cycle is crucial, which is inventory plus trade receivables minus trade payables. In international trade, the working capital financing requirement can be expressed as a number in currency or in days. That means days inventory outstanding plus days sales outstanding minus days payables outstanding. Let's understand an operating cycle through an example. Suppose the inventory is $500,000 and the days inventory outstanding is for 30 days. Now, the accounts receivables is $1,500,000 and the days sales outstanding is for 90 days. And the trade payables is $750,000 and the days payables outstanding is for 45 days. Let's find out what is the net working capital and also what is the cash conversion cycle. We will find out. So here, net working capital or NWC means current assets minus current liabilities. In this case, inventory is $500,000, accounts receivables is $1,500,000, and trade payables is $750,000. First, we need to calculate the total current assets and the total current liabilities. Total current assets is inventory plus accounts receivables, and total current liabilities is equal to trade payables. Therefore, total current assets is $500,000 plus $1,500,000, which is equal to $2 million. And the total current liabilities is $750,000. So, what is the net working capital? The net working capital is $2 million minus $750,000. That is equal to $1,250,000. Alright, what is the cash conversion cycle? As in the given example, the DIO is 30 days, the DRO is 90 days, the DPO is 45 days. Therefore, cash conversion cycle would be days inventory outstanding plus days receivables outstanding minus days payables outstanding, which is equal to 30 days plus 90 days minus 45 days, which comes to 75 days. So the net working capital is $1,250,000 in the company, which is available for 75 days. As we have discussed, the financial institutions or the banks primarily finance the working capital gaps for both. But trade finance is a much wider concept. It is an umbrella term that can refer to a variety of financial instruments used by importers and the exporters. The SMEs, large corporations, and even governments use trade finance to achieve its goals.
We will meet in the next class for more in other areas. Goodbye till then.
Thanks for watching the video till the end. Do let me know in the comment section any particular subject you want me to present for your sake. In the end, please do not forget to subscribe, like, share and comment on this video. We will meet in the next video. Goodbye.